Welcome everyone to this third lecture in financial risk management. And last time we stopped right before liquidity risk. Now everything we've talked about so far has had more or less of an indirect effect on the survival of the company. We talked a lot about potential sources for financial losses, but in the end it's liquidity. You can simply construct an example where a company will not have lost an awfully amount of money, but it can still go bankrupt. It can still default. Why? If you are not able to fulfill all your short-term obligations. And this is what liquidity is all about. You need liquidity to pay your debt, to pay your bills. Same with you as a private household. You might have a lot of money invested in stocks, but if you cannot sell those stocks to pay your electricity bill, well, your electricity company will shut off your electricity if you are not able to pay your bill. Okay, so that's liquidity risk. And liquidity risk, for obvious reasons, is very important to any kind of company, but it's very important especially for banks. Now, I've talked about this. All the risk we've seen so far, the risk types more or less have an indirect effect on the survival of the company, but liquidity risk is the imminent danger of bankruptcy, the danger of default, and risk management needs to deal with liquidity risk. Now, liquidity and liquidity risk and market liquidity risk are three different concepts. And even liquidity can be distinguished and differentiated between the liquidity of an asset and the liquidity of a company. So you need to be sure what you are talking about. We'll start with the liquidity of a financial asset or any asset. Is this building a liquid investment? Well, I would guess no. Is this chair a liquid investment? Is it a liquid asset? Usually not. Is a stock a liquid asset? Well, it depends. Is this computer a liquid asset? Also depends. What is, by definition, the most liquid type of asset? It's a trick question. Yeah? Yes. Cash, money. By definition, money is the most liquid form of an asset. And then what is the liquidity of an asset? How would you define the liquidity of an asset? In the literature you will find a very nice and very catchy definition of liquidity. It's the ease with which an asset can be turned into cash. If it's easy to transform an asset into cash or cash equivalents, it's very liquid. If it's not so easy, if it's difficult to transform it into cash, then it's illiquid. And you can see two aspects of liquidity. It's speed and it's a price impact. I can sell this house very easily if I were to sell it for €1. That's a huge price impact, and speed is given. However, if it's worth €1 million and I want to sell it for €980,000, it might take me a year until I find a buyer. So even if there is not a large price impact, liquidity might still be affected by the speed at which I'm able to transform it. And if I'm the owner of that house, if I'm a company that owns this real estate investment, and if I'm in need of cash, if I need to pay my bills now, the €1 million of the sale of this house will do me no good if it only comes into my balance sheet next year. That's why liquidity is not defined by just speed or price impact, but it's defined by the ease with which you can transform it into cash. In German die Leichtigkeit, mit der man einen Gegenstand liquidieren kann. So this is a very nice definition of liquidity. So then what is liquidity risk? It's the risk that you run out of liquidity. And what is the liquidity of a firm? The liquidity of a firm is its ability to pay all its due short-term liabilities. If there are bills that are coming into the company and I'm not able to pay my bills, I'm illiquid. I don't have enough liquidity. How can I pay my bills? If the company has enough liquid assets, cash, cash equivalents, or other financial assets that can easily be transformed, that can be liquidated. So you have liquidity of an asset on the one hand and the liquidity of a company on the other hand. For a company, it simply means the availability of liquid assets, cash, cash equivalents, assets that can be liquidated. And liquidity risk is the risk that you run out of liquidity, that you have a mismatch between your available liquidity and your short-term obligations. Okay. So liquidity of a firm is understood as its ability to fulfill all due obligations. And you can suffer from liquidity risk via two ways. First of all, you can run out of liquidity. You don't have enough cash on hand. The second possibility is you have the same amount of liquidity, but for some reasons, short-term obligations become active. You need to pay more than you expected. The same with you as a private household. You have your income, let's say you have 1,000 euros available each month. So it might be that you spend too much money, you don't have enough liquidity risk, or you have your regular 1,000 euros, but for some reason there is an additional bill that comes in and you now need to pay another bill for, say, your car insurance. Then that's the second source of liquidity risk here. Unexpected liquidity drain. Now, this is very important for firms because, first of all, it might endanger the company. The immediate consequence of illiquidity is filing for bankruptcy. And if you do not do this, this is one of the very few examples where, at least under German law, you will be subject to criminal law investigation as part of what in German we call Insolvenzverschleppung, or delaying in filing for bankruptcy. That's a criminal offense. So this is something very drastic, and this is why liquidity risk is of utmost importance to financial risk managers. Here on this slide you have a slightly more eloquent definition of liquidity risk, a risk that a company has insufficient liquid funds to settle all short-term liabilities. It might be caused by an outflow of liquid assets, might also be caused by a decrease in the maturity of liabilities, that is suddenly you have a new bill that comes in, and it could also mean that you have a refinancing risk. Now for companies, this is more important than for households. Refinancing risk means what? I'll give you a very simple example. If you buy a house, you will get yourself a mortgage loan on your house, and in many cases the mortgage loan will run for, say, 10 years or 15 years, and it's expected that you will not have your loan fully repaid after 10-15 years. But after 10-15 years, you need to renegotiate with your bank and get a new refinancing and a new loan that is in the amount of the rest of the loan that hasn't been repaid. Now what could happen is, if suddenly in between you've lost your job, you have no income, this might mean that the bank will no longer give you a new loan. And then you have refinancing risk. You suddenly do not have enough funds. It can be seen with households. It is a regular problem for banks and companies, but even with states and governments. If you remember the Euro crisis, Greece had the problem that Greece, just like any government, any state, finances its governmental budget, its state budget, by issuing so-called sovereign bonds, Staatsanleihen. And if you, what do you think? What is the usual maturity on a sovereign bond? Also die Laufzeit einer Staatsanleihe. 25, 30 years. So Greece issues, just like any state, issues government bonds for 25, 30 years. It now gets the cash to finance this year's budget and has to repay this bond in 30 years. And government bonds, sovereign bonds, are usually issued with notional amounts, say 5, 10, 20 billion euros. And what happened in the Euro crisis was that Greece and some other of the peaks state had issued bonds, sovereign bonds, say 20, 25 years earlier, and they now had to repay these bonds. And how do governments repay these bonds? By issuing new bonds, by refinancing. But during the Euro crisis, no one wanted to buy Greek sovereign bonds. So they had to come up with different sorts of financing, and they needed guarantees by the Eurozone to get additional financing. And this is what is meant, and what was meant in newspapers, if Greece and the Greek government was no longer able to get financing from the bond market. You know? And if you've read this in the newspaper, nowadays Greece has returned to the market for sovereign bonds, and it can again issue new sovereign bonds. It would have been able at that time, but only at ridiculously high interest rates. So risk will be reflected in your interest rate, and a government will not issue a government bond with a guaranteed fixed income of, say, 15%. That's too high. This is refinancing risk. You have refinancing risk, companies and even governments have refinancing risk. Liquidity risk is of particular importance for banks. Why is that? Banks are in the business of taking and giving out cash and money and capital. The basic business model of a bank is to take deposits from clients and to give out loans to companies, private households, even governments. So what is the idea behind banking? In one of the main functions of banks is maturity transformation. Each and every one of you has given money to your local bank with a short-term maturity. You can always go to your local Sparkasse or your Volksbank or Deutsche Bank, Commerzbank, and you can take your capital out of your savings account. So these are short-term deposits. But what does the bank do? The bank takes your short-term deposits and it transforms the maturity of this capital into long-term loans. If, for example, you buy a house, you will not have a short-term loan, but you will have a mortgage loan with a maturity of 10, 15, 20 years. So the maturities on the asset and on the liability sides of the balance sheet of a bank, they are transformed, and each bank will usually have what we call a maturity mismatch. You will have a short-term maturity on your funding side and a long-term maturity on your asset side. Long-term investments, short-term financing. And this is always critical. This is always dangerous because your financiers can withdraw capital at short notice, but your investments are long-term. What would this mean? If all of you go to your local bank, if you were customers of the same bank, and you were to go to your bank and reclaim your deposits, the bank would need to pay out those deposits. But the bank cannot come to me and say, well, congratulations on your house, and we are still very happy that we gave you the mortgage loan, but we need our money back, so please sell your house. And I will tell them, well, I don't have the money, I have this house, and I will repay my mortgage loan over the next 20 years. But if you want your money back now, I don't have it, and you cannot reclaim it. So the bank has liquidity risk, always. It's in the very foundation of the business model of any bank, a maturity mismatch between the asset and the liability side of the balance sheet. What I've just described to you is the classical form of a bank run. You get panicky, you think your local bank can go bankrupt, and you all run to your bank and get your money. Does anyone know, I always give this example. Is anyone from the UK? Oh, okay. In 2007, I think, during the financial crisis, one of the first events of the financial crisis was a very rare example of a bank run at Northern Rock. Northern Rock was a UK bank that experienced a bank run. Newspapers started to publish news that Northern Rock was almost close to bankruptcy. And what happened was that all the customers immediately went to their local branch of Northern Rock and demanded full repayment of their deposits. They wanted their money back. And bank runs are one of the main focus points of financial intermediation. Financial intermediation, you might know that we have some master's classes on financial intermediation taught by Professor Vollmer. Financial intermediation is more or less the economic side of banking. It's the economics analysis and economics related analysis of banking and the relation of banking when it comes to the economy. And in financial intermediation, there are a lot of models on bank runs. Why do people run? Why are people so stupid? There are many explanations why people run and why a deposit, why bank runs happen. A famous result is it's rational for an individual to run, but it's irrational for the collective. Why? If I know this is a bank and it might go bankrupt at any moment, if I run now, I might be able to get my money back. And if you are another customer and you are too late, you will lose your money. So it's rational for me to run. But if I run, you will see me running. You will right next. You will be the second customer demanding repayment. Then we're two customers. Then you will start to run. And then everyone runs. And we are causing the very bankruptcy we were afraid of. So it's a type of self-fulfilling prophecy that we do not want this to happen, but we are afraid this might happen, so we are causing the very phenomenon we are afraid of. That's a bank run. It's a self-fulfilling prophecy of a bank run. It might be due to complete irrational behavior. It might be due to information asymmetries. It might just be that I'm a rational investor, but I don't have enough information. And there are a lot of models on bank runs. And if you are interested in this, just look into a textbook on financial intermediation or take Professor Vollmer's class. I just like this example of Northern Rock. It's a modern day example of a bank run. What happened was, obviously, the Bank of England bailed out Northern Rock, and it saved the bank from bankruptcy. It closed down Northern Rock for a couple of days, so people could no longer get their money back. This is called a bank holiday. And in the UK, by the way, public holidays are also referred to as bank holidays. We are the same in German banking regulation. The German Financial Supervisory Agency, BaFin, can install what we also call Bankfeiertag. This means that for all banks or one bank, the banks are closed and you cannot run to your bank. And this is a very simple way to calm everyone down. And with Northern Rock, I just love this. Go to YouTube, search for Northern Rock BBC. You will get a very nice report from the BBC. On the very first day, people started to run and they are performing interviews with depositors. And I still remember one quote from a lady standing in front of Northern Rock, and the BBC reporter says, but haven't you heard, the Chancellor of Exchequer has guaranteed all deposits, so your deposits are safe. So everything's safe. And she says, well, that's what they said about the Titanic either. You know? It's not about rationality with bank runs. It's about the fear of losing your money. You know? Okay. For insurance companies, it's a little bit different. Insurance companies are different in the sense that they have a constant inflow of premiums, And liquidity inflow is much more reliable than with banking. And another reason why insurance companies do not have such a high liquidity risk as banks is that not only premiums are more predictable, but also runs are highly unlikely. What would you gain from running to your property and casualty insurer or to your life insurer? Life insurance is different, but imagine a property and casualty insurer, German Sachversicherer, Schaden- und Unfallversicherer. Let's assume every one of you is insured with, say, Allianz. And if I were to tell you that Allianz is close to bankruptcy, hypothetical example, would you cancel your insurance contract if you have your bike insured with Allianz? You would say, well, I still have my bike here. It has not been stolen. So if Allianz goes bankrupt, I will simply get a new insurance contract. There's no immediate loss. It would be a very improbable coincidence that your bike is stolen 5 minutes after Allianz has gone bankrupt. So there's not a real danger of you losing money simply because the company you have an insurance contract with goes bankrupt. It might be that it goes bankrupt and you lose your premiums, but in insurance, especially non-life insurance, the contract length is usually 1 year. You might know this from your car insurance. The contract length is always 1 year, and after 1 year, your contract is prolonged. No? So, an insurance run, highly unlikely. In life insurance, it might be, and it's not systematic. No, it's different with insurance companies. Now, we've seen the liquidity of an investment. We've seen the liquidity of a company, and both are related to the market liquidity. What is market liquidity? It's understood as the ease with which an asset can be bought or sold without the transaction having any influence on the market price of the asset. And ideally, an asset can be purchased or sold at its fair market value immediately and without affecting the market price. If, on the other hand, a security is not liquid, the seller must either accept a price reduction, what we refer to as a haircut, for the immediate sale, or wait for a certain period of time before the sale takes place at the desired price. So this is the market liquidity. And market liquidity can be seen here in practice. I have to be careful here. Put this in brackets, actually. This is rather the individual liquidity. Market liquidity is the liquidity, the average liquidity of the whole market. What you can see here is the absolute bid-ask spread of the stock of Deutsche Bank from 2005 to 2014. Now, we've talked about liquidity. The question now is, how can we measure? How can we proxy for liquidity? How would you rate the liquidity of this microphone? You would need to measure the price impact it might have if I sell this, something else. But this is esoteric. Yeah? The ease or the simplicity with which you can sell or buy something. The bid-ask spread is the best, more or less, best proxy for liquidity if you take a stock price at a daily frequency. Does anyone know what the bid-ask spread is? What is the bid-ask spread? I'll write it out. Anyone?
The difference between the prices for which you can buy the stock or sell the stock.
Ja. In German it's Geld-Briefspanne, also die Differenz zwischen dem Geldkurs und dem Briefkurs. This is something very, very simple. And I stress this in each and every one of my lectures because I'm, in German one would say, ein gebranntes Kind, because I never really learned this properly during my studies. Never ever think that if you are given an asset like a stock, there is a price or the price. There are many prices. And if you look at the microstructure, and this is what we call it, the market microstructure of a stock market, what happens? If we are market traders, if we are stock traders, what happens? Is there a price for a Daimler stock? If we are traders concerned about the Daimler stock, there is no price at all. At first, there is no price. With Deutsche Börse and all major other exchanges, stock exchanges, it works like this. You have limit order book. You will have an order book, and I might act as the stock exchange. You are the traders, and if you all remain silent, just like now, there will be no price, no trade, no liquidity. Now suddenly someone of you says, I want to buy a stock of Daimler for 100 or less. So you will make a limit order for, let's say, 5 stocks of Daimler with a maximum price of 100. Still, no trade, no transaction, no price. Only a limit order in the limit order book. Now someone else suddenly says, okay, I want to sell 10 stocks of Daimler for at least 120. No trade, no matching orders, no transaction, no price. Now all of you suddenly start to trade, you all issue limit orders, and I can see, okay, there is a time preference, we have timestamps on each limit order, some other types of orders, and I can now start to match orders. You wanted to sell for at least 100, no, you wanted to buy for at least a maximum amount of 100, you wanted to sell, and so on, and then I will match orders, and suddenly trades take place. Transactions. First observation is, if there is no one interested in trading, there will be no price and no trades, no transactions. Second observation is, during trading hours, there might be a non-continuous and unequal distribution of trades taking place. It might be that for 2 hours nothing happens, and suddenly every 5 seconds there's a transaction, and then again a 5-minute break, and then a transaction. And what can you observe if you take a newspaper? If you see, oh, the price for Daimler stock has increased, what does it say? In a newspaper, you will probably see what? You will see an ask price and a bid price, and these two are the ask and bid price for the last trades on a trading day. Those are the closing prices, die Schlusskurse, for the last trades that took place on this particular trading day. The last trades meaning that this is the price someone asked for buying or someone for selling the stock. And both prices, ask and bid quote, tell you what people are expecting if they were to buy or to sell this asset. Now, we could also have a bid and an ask quote for this house. It might be that if you were to own this house, you would buy it again for 1 million and you would sell it for 1.5 million. So you have a discrepancy, a difference of 500,000 euros. And this is the bid-ask spread. And obviously, if I were to take this pen here, I bought it, let's say, for 10 euros. How much would you give me for this pen? 9 euros and 90 cents? Probably not. I would be lucky if I were to get 2 euros out of it. A huge bid-ask spread. Why? It's not very liquid. If I were to offer you a 10 euro bill, how much would you give me for this 10 euro bill? And how much would I ask for a 10 euro bill? Well, 10 euros. So if we were to exchange a 10 euro bill and 2 euro coins, there would hopefully be no bid-ask spread. Why? Because cash has infinite liquidity. So the bid-ask spread reflects the liquidity of the asset. The higher, the larger the bid-ask spread, the more illiquid the asset is. And if you take a newspaper and look at the bid-ask spreads on those major stocks like Apple, Google, etc., you will see very tiny bid-ask spreads. And here you can see it for Deutsche Bank. Deutsche Bank has had bid-ask spreads of about 10 euro cents most of the time. And you can see, well, you cannot see this, maybe you can see it if you enlarge it on your slide. There are some peaks here. And actually, on this day, here, the bid-ask spread increased to almost 1 euro. Do you know why? Look at the date, 2009. There was a financial crisis, and at that point, everyone wanted out. Everyone was selling, no one was buying. And if everyone's selling and no one's buying, this will put selling pressure, price pressure on the stock, and the bid-ask spread will increase dramatically. And again, afterwards, you will see small and tiny bid-ask spreads. This is the relative bid-ask spread, and it's almost 3%, a 3% markup on the price, meaning that if you were to invest 100 euros in the stock of Deutsche Bank, you would have to pay a premium of 3% just for liquidity. 3% of the price is just liquidity. Okay. Yeah, this is the bid-ask spread. And why did I put market liquidity in parentheses? Well, this is the individual asset's liquidity. It's the ease with which the asset can be sold or bought. However, market liquidity is just the same if you were to take not just Deutsche Bank, but if you were to take the DAX or the S&P 500. If you were to look at the bid-ask spread on the DAX, the average spread on a market, you would get market liquidity. And obviously, there are actually quite sophisticated models that show this. Individual asset liquidity is heavily influenced by market liquidity. If the market dries up, your individual assets liquidity will also be affected. But this is highly sophisticated. You need highly sophisticated models to show this. I will not look at this. Again, and the bid-ask spread here, absolute bid-ask spread in 2008. And you can see this is one way to measure liquidity. There are other proxies for liquidity, updating frequency and some other things. But the bid-ask spread is, I would say, the most frequently used proxy for liquidity. Okay. And I already talked about this. Market liquidity, asset liquidity, firm liquidity are directly connected with each other, and this causes liquidity risk. We'll later see some things you can do about liquidity risk, but we are still in this chapter where we are only defining and summarizing the different types of risk. So let's now turn to operational risk. What is operational risk? Op risk. Until now, the common denominator of all risk types was that they had an exogenous character, something exogenous to the firm changed, market prices, market surroundings, and they were related to the core business of the firm. For example, well, we are giving out loans as a bank, we have credit risk. We are an electricity company, we have commodity price risk. If we are an asset manager, if we are buying and selling stocks, well, we have market price risk from the stocks we are invested in. However, financial risk can also arise from A, endogenous sources or exogenous influences that do not really belong to the core business of a firm, and something endogenous, own employees, internal processes, something that's not correct in the inside of a firm. I've explained this to you, I think, in one of the first lectures, that operational risk was introduced to risk management by the Basel II regulation. The idea was that financial regulators, bank regulators, said we are dividing bank risk into three categories: credit, market, and the rest. And the rest we are just coining now operational risk, because it's related to the operations. And this is why, by definition, operational risk is a summary and a melting pot of quite different types of risk. We'll see a definition later on, but here you can just see that it's based on the Basel II capital adequacy regulations for banks, and it was introduced into German law as paragraph 269, section 1 of the Solvabilitätsverordnung, the executive order on the solvency of financial institutions. Just so that everyone knows this. Under German law, we have more or less 3 or 4 different types of laws. We have our basic law, Grundgesetz, as a constitution. We have regular laws passed by Congress, by Parliament, Bundestag, and ratified by the federal president. And we have what is best translated into English as an executive order. And executive orders in German are Rechtsverordnung. And every time you see something with the German ending Verordnung, this is an executive order based on a law passed by Parliament. And I can give you a very simple example where you can see the difference. There is a German law, Straßenverkehrsgesetz, the law that governs traffic in Germany on all German roads. And this law was passed by Parliament, and it basically states that all roads in Germany fall under the same set of rules. And the exact and the precise traffic rules are laid out by the Ministry of Traffic as part of an executive order. That is why we have a Straßenverkehrsgesetz, a law that governs traffic rules, but we also have an executive order, die Straßenverkehrsordnung. And if you want to know all the different traffic signs and stop signs, etc., in Germany, you will have to look at the executive order and not the law. This is done by the ministry. And it's the same here. This is not a law, it's an executive order based on a law that states that German banks fall under the supervision of the Federal Financial Supervisory Agency and Bundesbank. Okay. And in 269, paragraph 269 of the solvency order, operational risk is defined as the risk of losses arising as a result of the inadequacy of failure of internal procedures and systems, people, or as a result of external events. This definition includes legal risks. That's the whole definition. And as you can see, it's everything. It's legal risk, it's people risk or personnel risk, whatever that is meant to be. It's external event. Now, everything is an external event, yeah? If the sun doesn't shine tomorrow, this is an external event, if it causes any financial loss. So it's a very basic and very general definition, but it's quite clear to any financial risk manager what operational risk is. One warning is in order. Operational risk does exclude strategic risks or reputational risks. I have told you this in the very first lecture, that financial risk management is not about strategic risk. If I don't know my customer, if I don't know my business, this is my problem as an entrepreneur. It's not something that is of concern to a financial risk manager. Reputational risk, yes and no. There are some people that argue that reputational risk is also a risk for as part of operational risk. Sometimes not. For example, here for Solvency II, the equivalent of Basel II for insurance companies, the GDV, the German lobby group of the insurance sector, states that reputational risk arising from and so on are not covered by operational risk, similar to Basel II, but they also consider reputational risk as part of operational risk. So the definitions differ between banking and insurance companies, and some people even think reputational risk is relevant for banks. Now, what are operational risks? First of all, if any of your employees does something illegal or something that's not allowed, that's an operational risk. Everything that's related to the IT infrastructure. Everything that is related to natural disasters, unless you're an insurance company, especially a reinsurance company. If you are a reinsurance company, well, natural disasters are your core business, then it's not op risk. But if I told you this example, if this projector falls down on you, unfortunately, this is an operational risk for the university. Why? Someone is harmed, you will have a financial loss. Why? Because we have an exogenous event, maybe a failure of the IT or some other natural disaster, something that's not related to our core business. It's not a credit risk, it's not a financial risk, but something endangers the production process. If we have a fire in the shoe shop next door, this is also operational risk. So how is operational risk characterized? Usually it has a high claims amount. If we have a fire here and the building burns down, this is a huge loss and a very low probability of occurrence. What is the probability that this whole building burns down to the ground? Very tiny. What is the probability that a meteor or an asteroid falls right down at this spot? Highly unlikely. So this is operational risk. High losses that only arise at a very low frequency and a low probability, and therefore as a result are very difficult to measure. And operational risk is probably the part of risk management that creates the most headaches to financial risk managers because they usually cannot measure it. What's the probability of a meteor hitting the shoe shop and not the university? Well, who knows? There are some famous examples of a number of risk types connected to each other. This collapse of Barings Bank in the 90s, you might remember this. We had a rogue trader, meaning that an employee did something illegal and something that was not detected by internal processes. So you had personnel risk, failure of internal security protocols, illegal behavior of a single rogue trader, and in combination, you also had an external event, a natural disaster, the Great Hanshin earthquake of, I think, 95, in Kobe, in Japan. That caused Asian markets to spiral down. And if markets hadn't plummeted, no one would have noticed the high and huge losses incurred by this rogue trader at that time. So this is a prototypical example of an operational risk. Illegal behavior, lack of sophisticated control protocols and processes, and a natural disaster, all in combination. Actually, a second very famous example for an operational risk, unfortunately, again from Japan, is the Tohoku earthquake that caused Fukushima, Daiichi. In that scenario, well, everyone knows you have earthquakes in Japan, almost every day. And all nuclear power plants are earthquake-proof. Problem was, no one thought about an earthquake taking place not at the power plant, but in the ocean, and the nuclear power plant was not tsunami-proof. That's prototypical operational risk. It has nothing to do with nuclear fission. It has nothing to do with the, I would say, core business of TEPCO, the company that operated the power plant. It's an external event. And if they had only built some type of protection against tsunami, the whole thing wouldn't have happened. But because of the external event and the lack of security procedures, this risk, highly unlikely, with a huge loss, occurred, and that's operational risk. Okay. Then, you sometimes, obviously only with insurance companies, you also have actuarial risk. Actuarial risk is defined how? First of all, what is an actuary? Actuary, German Aktuar, is more or less an insurance mathematician, a risk manager that works in an insurance company or a reinsurance company, uses methods from actuarial science, which basically is insurance mathematics combined with insurance law and insurance regulation and insurance accounting, that works on insurance mathematics and does what? Calculate premiums and calculate reserves. In the end, an insurance company is what? An insurance company has an asset and a liability side on its balance sheet. And what's the basic business model of an insurance company? If I'm the insurance company, I offer you an insurance product, I will get premiums, and I will have equity. The premiums are my liabilities, more or less, and I will use these to buy some assets. And the premiums are what? In contrast to a bank, where a bank will take deposits and it will have to repay all its deposits, what happens with an insurance company? If, for example, you have car insurance and you pay 500 euros each year for your car insurance, will the insurance company pay back all those premiums? No. Only in case of a loss, only if you crash your car. So, in contrast to a bank where a deposit is an unconditional claim against the bank, the insurance company will get premiums and it will have a conditional, insurance policyholders will have a conditional claim against the insurance company on repayment only in case they incur a loss. Meaning that you will have not the premiums here, or you can say the premiums in brackets, or so-called reserves. The insurance company will build reserves on its liability side, and it will need to repay a fraction of the premiums, and it will invest the premiums and make a profit, hopefully. But for this to work, you need mathematicians who calculate the premiums, the potential losses, and based on your potential losses, the reserves. German, in short, was macht ein Aktuar? Der rechnet die Prämie aus, die Prämiensätze, und dann werden die versicherungstechnischen Rückstellungen, so nennen sich Reserves, versicherungstechnische Rückstellungen gebildet, weil sie ja möglicherweise Prämien zurückzahlen müssen, wenn zum Beispiel ein Versicherungsnehmer sein Auto gecrasht hat. Und dann werden diese Gelder investiert, die erzielen eine Rendite, und im Idealfall ist die Rendite im Asset Management höher als das, was sie letztlich dann auch auf der Passivseite wieder auszahlen müssen. Das ist das grundsätzliche Geschäftsprinzip, letztlich insbesondere in der Nicht-Lebensversicherung, in der Krankenversicherung natürlich genauso. Und weil all diese Ansprüche stochastisch sind, Sie wissen ja nicht, wie viele Leute ihr Auto crashen werden, müssen Sie das Ganze aktuariell berechnen, ja, unter den gesetzlichen Voraussetzungen. So this is what an actuary does. Calculate premiums, calculate reserves, and Actuarial risk relate to questions of the actuarial modeling of claims and premiums. Actuarial risk then is what? It describes the possibility that a model or assumptions made in it for the calculation of a risk-adequate insurance premium it is not close to reality or delivers false results due to unforeseeable external events. You have to be careful now. In actuarial science, in insurance company, you want to take these risks. And you know that some people will crash their car. That's a given. You will model these risks and you will use models to calculate your premiums. So actuarial risk is closely related to model risk. It means that your actuarial models are inadequate. You know you will incur some losses, but your model is wrong and it's off. This is actuarial risk. So such a miscalculation often arises from an underestimation of the likelihood and the level of potential claims, and in order to limit such actuarial risk, the actuarial department of an insurance company always pursues the following objectives. First, improve the estimation of the loss distribution, and continuously reviewing and revising actuarial forecasting. In some cases, this is very simple. Very, very simple case. Does anyone know which is perhaps one of the toughest business lines of an insurance company? Where is competition the strongest? And you all know this. Where will you get the best prices? Easily. And where can you compare prices very easily when it comes to insurance? Best example? No one? Okay, you're all riding a bicycle. Car insurance. There is no business line, Sparte, in insurance where competition is stronger and tougher than in car insurance. Just go to a website like Check24, Check24, compare prices, and you might get a car insurance premium that is even 10 euro cents lower than the best offer so far. And why is that? Millions and millions of people drive cars. The insurance companies have lots of data, and the contracts only last 1 year, and every time you have a claim, the company can change your premiums. You might know this if you have a car accident, premiums will go up, so the company can react to this change. And that is why it's very easy to calculate the average risk of a loss in a portfolio. It's totally different for an insurance company that insures a nuclear power plant. No insurance company will insure a nuclear power plant on its own. They will form a syndicate, and then might be that they will insure a nuclear power plant. Why? Because it's very difficult to estimate that probability. But if I were to tell you, I'm a 38-year-old male driver of a Toyota Prius, yeah? And I have no accidents so far, I have this income, I have a garage. The company will access all this data and they will very accurately estimate the probability that I will have an accident during the next year. So it's very easy to calculate the premiums, lots of competition. Yeah? And this is what is done here in actuarial science. Calculate losses, and based on the calculated and estimated losses, calculate the premiums. By the way, who has already taken a class in insurance economics? Okay, everyone, because we don't want to offend Professor Wagner if he watches the video at home. Let's assume you've all taken a very basic lecture on insurance economics. The fundamental result, one of the fundamental results in insurance economics, in contrast to insurance management, I guess, is the fundamental, equivalence principle of insurance pricing. This Äquivalenzprinzip. What does it mean? It means that premiums have to equal what? Expected losses. That's the basic result in insurance economics if you are interested in a fair insurance premium. Fair meaning that neither you nor the insurance company makes a profit. The same as an arbitrage-free price in a security market. That's the equivalence principle in insurance economics. It means that the fair price, the fair premium of this contract is your average loss, your expected loss. The insurance company will slightly increase it to make a profit, but that's okay. But this is what you need to calculate a fair premium. And in the end, you can also get this result, small p equal to pi. This simply means the premium rate should equal the probability of a loss. That's also another way to state the equivalence principle in insurance economics. But what does this mean? It means how to calculate premiums. It always comes down to calculate your expected loss. So you take your portfolio of car insurance contracts, you calculate your losses, and if you know your car is worth 20,000 euros, the probability of an accident is, say, 1%. 1% times 20,000 euros in the next year, so the fair premium is 200 euros, and you're done. The company will then charge 220 euros, and it will make a profit, or it can at least cover its costs. Very simple insurance pricing and actuarial science in a nutshell. But this is how it works. You calculate your expected losses and you set premiums accordingly to the equivalence principle. But, because this is not an insurance class, this is everything I'll say about this here. So, to what extent could the results on actuarial risks also be relevant for non-insurance companies? Now let's turn to the question, how can we use this if we are, for example, the shoe shop next door, if we are not an insurance company? Well, in some cases, especially large companies, might be faced with the question, should we buy insurance or should we just accept the risk? Should we buy fire insurance here, or is it okay to install fire detectors? And do you know how this works in wholesale business with large companies? They will go to large insurance brokers, and you probably don't know the names of these large companies. One large company, one large insurance broker for companies is, for example, Marsh, M-A-R-S-H. There are specialized insurance brokers that have specialized on finding the right specific insurance contracts for companies like Daimler, BMW, etc. Now, if you are a private household, you will go to your next insurance agent. That's quite clear. If you need a car insurance, you go to the internet. But Daimler will not look up an insurance contract on the internet. It will need a highly specific and individual insurance contract, for example, for a fire insurance of a plant, and it will go via an insurance broker like Marsh. And they will try to get offers from different insurance companies, and they will try to find the best insurance contract for Daimler. Now, in this scenario, if you know you need an individual insurance contract, and if Allianz, for example, tells you, we can offer you fire insurance for 50 million euros a year. The difference to the car insurance example is that with car insurance, it's a mass market. These contracts are very general. They are very generic, actually. And it doesn't matter if you buy a car insurance from Allianz or Coburg or Ergo, the contract will be the same. But the more individual the insurance contract will be, the more intransparent the premiums will be. So if Allianz asks for 15 million and Ergo asks for 12 million, which insurance contract should you buy? And how could you rate this? You could try to come up with your own fair insurance price. You can calculate, you can use the same methods. I mean, this is not rocket science in many cases. You can use some quants and they can try to come up with their own fair insurance premium. And if they see, well, we can install fire detectors for 5 million and fire insurance will cost us 15 million, we go for another option. We don't need insurance. So this might be one idea where you can use results on actuarial risk, even in a non-insurance company. You can simply try to mimic the insurance company and you can try to understand how the insurance company came up with this price. But this only makes sense for large companies. Okay, now actuarial risk was defined as the risk that an actuarial model for estimating and forecasting financial losses was inadequate. So more or less, it's a special case of model risk. Model risk is something different. Model risk is not per se a financial risk. It's even philosophical in nature. It's the risk that you have used a model in risk management that was inadequate. That's basically it. Wrong model. Or you have used a correct model inadequately or falsely. I might have talked about this model risk. Did I tell you of this example of the Millennium Bridge in London? No one remembers. Okay. Model risk is also related to endogenous risk. Endogenous risk, in a very simplistic way of defining, could be a risk that arises from within the company. But in a more strict sense, and then it really becomes philosophical, endogenous risk can be the risk that is created by trying to prevent risk. So it's German, die Katze, die selbst in den Schwanz beißt. It's even a scenario of the chicken or the egg, what was first. Endogenous risk and endogenous risk and model risk has been studied in the last years extensively by Jon Danielsson from the London School of Economics. And Jon Danielsson has some very interesting papers out on model risk and endogenous risk. And endogenous risk gives a very good example for endogenous risk. The London Millennium Bridge, that is a pedestrian walk across the River Thames, open for the Millennium. And the bridge was specifically designed to withstand strong winds on the River Thames. So if you are a pedestrian on the bridge and there is heavy wind on the River Thames, the bridge shouldn't move too much. It's a pedestrian walk. When it opened, it moved quite heavily and had to be closed because there were videos where you could see that people had difficulty standing on the bridge. What was the reason for this? Wind wasn't the problem, but when wind became stronger, all the people on the bridge started to counter the movements of the bridge with their own body weight. And the weight of all the people going in synchronicity started the bridge to become unstable. That was a problem. Not the wind, but the wind in combination with a couple of hundreds or even 1,000 people on the bridge moving in the same direction at the same time because they were trying to counter the wind movements. That's endogenous risk, a risk that is caused by your countermeasure in the strict sense. And it's also part of a model risk because, well, why is it model risk? Well, engineers, bridge engineers, were aware and had a model for wind, but their models were inadequate because they didn't account for the people. They didn't account for one key ingredient. People are also standing on the bridge when the wind comes in. That's inadequate risk modeling. Can be caused by several factors. Wrong model, wrong data, overinterpretation, and so on. And model risk is the risk that a company suffers from a financial loss from the use of a model that shortens reality too much or the incorrect calibration, estimation, or use of a model. You have to include a too much here. Why? Well, a model, by definition, is a shortening of reality. If you take reality and you leave some important or non-important parts out, that is a model. But if the model is too simplistic, that's model risk. Okay. Some different types of model risk. Using the wrong model. Model is incorrectly implemented. Can be a simple programming error. Wrong use of the model. Data problems. Incorrect model calibration. Overinterpretation of the results. Now, I can give you a risk model. Now, if you think it can predict tomorrow's lottery numbers, that's overinterpretation. The model might be the correct model, the correct data, no programming errors. But if you suspect or if you expect the model to forecast tomorrow's lottery numbers for you to become a millionaire, that's overinterpretation. Yeah? That's something the model cannot achieve. And there are numerous examples how you can wrongly use a model, and that always leads to model risk. So what examples of model risk can you think of? Coming from the realm of finance. Anything you can think of, maybe from some previous lectures. Some examples of model risk. Every one of you has taken a class in statistics, right? What is an ordinary least squares regression? What is an OLS regression model? I want to explain your grades in the final exam. And I'm explaining your grades in the final exam, which are shown here on Y, on the Y-axis. And I'm explaining your grades by using the number of hours you've spent sitting here. So that's your X. And we have some people who are doing exceptionally well. They don't come here and they get a good grade. We have some people who come here but sleep. We have some people in between here. And the majority, maybe more time spent learning, better grade. And from statistics, you know what is an OLS regression model? It's, well, exactly that. It's a linear function drawn through this cloud of points, and you try to explain the functional relation between X and Y by writing Y is alpha plus beta times X plus epsilon. Yeah, plus an error term. That's a regression analysis. Do you think this is a valid model? Let's take this very simple example. It's not from finance, but you know what it's about. First of all, who says that it's not a function like this? An OLS regression, an ordinary least squares regression, assumes a linear function. Could also be a polynomial, a nonlinear function. So, wrong model. If I were to count the numbers of the hours spent learning, I need to measure this. There might be measurement errors. Could be input data errors. If I use R or if I use another program like Excel to calculate this regression analysis, I might include a programming error. Then I have another source of model risk. And if I were now to use this model, I estimate the model and say, well, I'm now interpreting these results to predict your overall grade. It might simply be that you are overly, or the opposite, motivated in this class, but you're doing much, much better or much, much worse in other classes. That's overinterpretation. So there are several examples for model risk. In risk management, if we're trying to forecast financial losses, wrong model, linear versus non-linear, functional relation between the variables, wrong data. Sometimes you have measurement errors. In finance and financial economics, usually not, because we can observe stock prices and loans and financial outcomes directly. In engineering, this is different. In engineering, also in den Ingenieurswissenschaften, and in natural sciences like physics or chemistry, you will always have measurement error. What is the distance between the Earth and the Moon? Well, probably some distance plus minus a measurement error. What is the weight of a molecule of, say, oxygen? Measurement error. What is maybe if you take the structure in this building, if you take any engineering metrics, there will also be measurement errors. So this is true in natural sciences and engineering, not so true in finance. There is one exception. As soon as you move towards high frequency data, so stock prices taken at, say, 5-second intervals on a trading day, when it comes to high frequency data, it might be that you are not able to measure prices without measurement error. There might be some errors in the data. But if you take stock prices, daily stock prices, take a newspaper, look at the end of day quotes, and those are your prices. Okay. Some sources of model risk. Wrong pricing model for securities. Inaccurate estimation of market indexes. Forecasting period is too long. Simplifying assumption in capital market models. No transaction cost, liquidity cost. A risk-free interest rate. Now this is what you all know from basic finance classes. It's a perfect capital market with no transaction costs, no taxes, a risk-free investment. Everyone's rational. Every investor has perfect information. Well, not so much in reality. We have dumb investors, taxes, transaction costs, not just one single risk-free investment. And what is the risk-free investment? So all those typical model assumptions in financial models, they are usually not fulfilled in reality, and this will introduce model risk. Data errors, general overstringing of models and excessive complexity of certain tasks. Models for forecasting tail events, determining systemically relevant financial institutions, and so on. This is quite interesting. What can you do to counter model risk? You can use several models. Use multiple models and interpret the differences found. If I have 3 models for pricing a stock, if I'm interested in the fair price of Daimler stock tomorrow, and I have 3 models, and the 3 models give me 100, 101, and 101.1 euros, I would say, well, the differences between those 3 models are not very large. If I have 3 models and they forecast the stock price to be 100, 150, and 250, well, the discrepancy between those 3 models is quite large, and we have high model risk. I can use a worst case or model averaging approach. I can simply ask myself, what is the worst case scenario? Well, I can lose everything. Yeah? It has to be sensible, of course. You know this famous saying, well, in the long run, we are all dead. I mean, a worst case scenario should be realistic in the sense that it's not the end of the world, but it is something that might happen at, say, 1 or 5% probability. I can use a benchmark. I can use limiting cases, extreme scenarios. I should use the principle of parsimony. I should use a parsimonious model. You know the German word for parsimonious? I had to look it up myself. I only knew the English word, sparsam, in relation to models. It means that you try to get the same result with less parameters. Very simple observation is, if I use a regression analysis or any analysis, any model, and I have one parameter, like in a regression analysis, think of this. I want to estimate your age, the average age of the students here in this class. And I could come up with a simple regression analysis that looks like this. Oh, no, not age, your grade. And I'm explaining your grade with age. So X is age, and that's your final grade. Now in this case, we have 30, 40 observations and one parameter beta, or two parameters alpha and beta, that need to be estimated. So in this case, we have 2 degrees of freedom and 30 objects we need to fit our model to. So in the end, how will this look like? It will look like this. And the model will look something like this. Okay. Now, if I were to increase the number of parameters, what will happen? In a sense, I can do the same by reducing the number of observations. Now, if I only have 1 or 2 observations, the result will look something like this. This is what we call overfitting. If you have a model that is too flexible, that has too many parameters, you can fit anything. You can estimate anything. If I were to ask your 2 ages and 2 grades, I have 2 points where I can connect 2 dots. Then I have my model, so to speak. And this is why we are interested in parsimonious models. Models that only need a low or small number of parameters to sufficiently explain the functional relation between our variables. And that's a parsimonious model, a sparsames Modell. Because if I have too many parameters, I will get overfitting. I will explain the noise in the data. And this is not what we want. And last but not least, we can do back-end stress testing. I can do what? Back testing is very simple. If I again want to explain the grades by using age, I will make a cut here along the aisle. I will estimate my model using your data, and then I will look at your grades and your ages, and I will look at the question how the model performs with these estimated parameters compared to your data. And then if I see, well, the model has performed quite nicely, I can leave it. If I see the model is inadequate, I have to change it. That's backtesting. Checking the accuracy of your model by using new data and by constantly renewing and reassessing your parameter estimations and model assumptions. And that's backtesting. It refers to the process of evaluating a risk model by applying the model on historical data and checking for the adequacy of the model. It's adapted and corrected. Very simple example, you can forecast the share price with a model, and then you just wait maybe a month or a year, and then you check it again. How would the model have fared if I were to use it now on historical data? If the model is good, leave it. If not, change it. Stress testing is something very similar. Stress testing means that you take your model and you look at the consequences of extreme scenarios. And you might know this from banking and from central banking. This is what central banks do nowadays regularly. They do stress tests and they ask the question, what would happen to the European banking sector if unemployment went up by 2%, if GDP growth was negative, if we were to enter a recession? How many European banks would go bankrupt under these extreme adverse circumstances? And that's stress testing, and that's a macro stress test. But you can also do the same with a company. For example, the shoe company would do a stress test. What would happen if revenues went down by 10%? Would we go bankrupt? Would we have enough liquidity if our sales went down by 10%? Very simple individual firm stress test. Okay. Now, we've completed our discussion of risk factors. And I have 5 minutes left for the identification of risk sources. I will give you a short idea of what this section is all about, and then we'll discuss it next time. What is risk mapping and elementary risk factors? We've talked now enough about risk types, credit risk, reputational risk, op risk, and so on. And for most risk factors and risk types, risk will boil down to some elementary risk factors, elementare Risikofaktoren. And what are these risk factors? Everything that at the very bottom of the risk drives financial losses. What are the elementary risk factors for credit risk? Assume you're a bank. What are the basic risk factors for credit risk stemming from a loan? What can change? Imagine you've given out a loan to Daimler. What can change? What drives credit risk in this example? No idea. Something that cannot be changed from your point of view. And in the sense of a loan to Daimler, it's what? Market interest rate and default probability. It's not the loss, but the loss is caused by a change in the interest rate and by a change in the default probability. Now, what's the elementary risk factor behind a stock investment? You have a stock. You've bought a Daimler stock. What is the risk factor there? Very simple. Stock price. Done. For a stock investment, it's very simple. It's the stock price. For a loan, for credit risk, it's a little bit more tricky because interest rates also play a role and default probability. What are the elementary risk factors for a financial derivative? Für ein Derivat. First of all, it depends on the pricing model. And if you take the Black-Scholes option pricing model, it's volatility, current stock price, interest rate, maturity of the option. So you already have 4 elementary risk factors. So in this section, for several very simple financial investments, we'll have a look at what elementary factors are actually driving financial losses. And this, in the end, will be part of risk mapping. Risk mapping simply means you model your elementary risk factors. Those are interest rates, market index values, prices, default probabilities, etc. And then they will be combined as part of risk mapping, and this risk mapping will determine how financial losses arise from changes in risk factors. And this is one part of the modeling you have to do. You will have to think about what risk factors are actually driving financial losses, and how can these elementary risk factors be combined to come up with an estimation of the financial losses. Okay, do you have any questions? Well, if not, let's stop here, and we'll go on from here in section 3 next week. Thank you.